And let's start with what happened this weekend as a start, right? So obviously, there's this war going on in Iran, and unfortunately, we have a lot of oil production in that part of the world, and that is leading to oil prices flying. And so the price of oil went from about $65 a barrel all the way up to about $110 a barrel over the last 2 weeks or so. And this weekend, we saw a massive shift in this weekend and last weekend in price discovery for markets that are closed on the weekend. And
like oil.
And if you think about it, there's a broader shift happening about how these markets are reacting due to the crazy nature of the kind of administration that we're currently in, right? So there's this consistent news barrage in the world today. I like to think of it as like a 24-hour amnesia where something happens in 24 hours that is like a mind-blowing event that would be a once per month 5 years ago. That happens every day now, it seems. And so this is leading to markets being far more volatile, to more wars, to more things, more headlines. Like everything has been compressed into a headline. And so what this has done is that it has created a lot of opportunity for markets on the weekend. And markets on the weekend are increasingly becoming something that the NYSE has pushed, that we've seen people from ICE push, obviously today with Kraken and NASDAQ. And so I think just to start off, this regime shift is a more volatile world, is leading to a much stronger desire to trade 24/7.
Well, I think you're right that we're compressing a lot more substance. Things that would normally take a lot of time are now taking much shorter time.
Yeah.
This is attributable to several reasons. I think one is the internet. I think faster communications, faster transportation, and generally a more connected world than ever before. And there was previously this 12-day war, right?
Yeah.
It was over in 12 days.
Yeah.
50, 100 years ago, these wars are drawn out.
Yeah.
So now things are getting compressed in real time, and they're happening much more frequently.
Yeah.
I think also, if we're looking at this relative to the markets, we're thinking about how price discovery happens. And I think that is part of the key, the cornerstone of this conversation, which is a thesis that actually Solana ran with for a long time, of always trying to be, approaching the speed of light, so that they were one of the fastest paths of information and lowest latency.
Yeah.
And what that allowed for is the quickest price discovery. And if you can get liquidity behind price discovery, liquidity begets more liquidity.
Yep.
And price discovery ultimately is pushing the needle. So what you're alluding to and what happened over the weekend is that obviously traditional markets were closed.
Yep.
And we're having developments, not in Europe, because Europe takes the weekends off,
Yeah.
but here in America and over in the Middle East,
Yeah.
we had developments happening over the weekend.
Yeah.
The Strait of Hormuz, which is where a lot of the oil travels. I believe it's 20% of the entire world travels through this very narrow strait. Iran is threatening, saying that they're going to torpedo any boats that cross through the strait. America and Trump is saying, hey, we'll give you protection. We'll give you an escort along the strait.
Yep.
Don't worry about Iran's threats. Keep the oil flowing. The insurance markets are starting to say, hey, if you travel through this strait right now, we're not going to insure you.
Yep.
That is causing, even with this police escort, and so that is causing a lot of these boats to effectively say, no, we're not going to travel. That slows down the supply and the production of oil, leading to, obviously, demand hasn't shifted. Everyone still needs oil, still needs gas. And so maintaining demand, short supply,
Price flies.
And so price appreciation flew over the weekend where all other markets were closed.
Exactly.
The only market venue that was open, obviously in a more open competitive landscape, you're going to be pushing the edge on latency, getting closer to bare metal, these sorts of things. The legacy markets are making it extremely easy for Hyperliquid because it was just the only liquid venue that was open trading these assets. And so yes, Hyperliquid was the venue of choice for price discovery of oil over the weekend.
Yeah. I mean, and the platform itself has processed, trillions of dollars in trading volume. It surpassed Coinbase in annual volume. Also, something with regards to the sign of the times. Again, these tokenized commodity markets are hitting a massive scale right now. Partially because crypto markets are far less volatile currently and less appealing. And so, over the weekend, there was actually more that the top 5 pairs on Hyperliquid were non-crypto pairs for the first time in a while, which is, again, a sign of the times. Part of this regime shift. I'm not saying that that's always going to be the case. In fact, it's probably not going to be the case most of the time. But the fact that the top 5 pairs over the weekend was showing that they weren't crypto pairs is a sign that investors, speculators, asset owners want to speculate on these markets on the weekend, just generally 24/7. And they want to do it in a place that has good volume, good high levels of open interest, and they want to do it at scale.
I think increasingly we're going to see those types of assets higher among the volume ranks on crypto exchanges.
Yeah. And I mean, you see it, right? Like BitGet, we had their CEO on, and she was talking about how they are the universal exchange now. They just listed a bunch of gold pairs and these types. Bybit's doing it. Binance has it.
Remember, this is part of the Neo Finance Thesis.
Yeah.
Remember, the Neo Finance Thesis is essentially an acceleration of the assets that have typically been the most liquid and the most traded for centuries.
Yep.
Oil, gold, silver. These are the assets that people want to trade. We're not suggesting that we're going to take XYZ crypto, equity token, and it's going to become the most liquid traded venue ever, right?
No, yeah.
What we're suggesting with the Neo Finance Thesis is that we're going to improve the rails. The platform through which these assets trade is going to be exponentially faster, more affordable. It's going to settle quicker. It's going to unlock latent liquidity, and it's going to be composable with all of the other venues that are currently disparate. And so part of the Neo Finance Thesis is that we're taking these high quality assets, the assets that move most of the capital in legacy markets and in the Neo Finance markets.
And we're going to bring them on chain.
And we're going to be innovating them. We're going to bring them on chain.
And so we'll get better assets on chain as a result of this phenomenon as well. We'll get different types of assets on chain, better types. And the big thing here, so to kind of like round out this first point about this regime shift, how to position, obviously we're both Hyperliquid bulls. We own Hype. But these markets represent trillions of dollars in annual trade with tens of billions of dollars in futures volume, right? And so if you just think about how these percentages of these markets start to come on chain, it's just like so obvious that the market volume that is being done just on perps in crypto is going to be first kind of like joined by and growing together. But I think that the volume of these, as you're saying, these larger, better assets, higher quality assets, is going to grow, supersede the volume of the perps on crypto assets. And the other thing here is that to kind of finalize this point and move on from Hyperliquid and kind of this tokenized commodities trading is perpetual futures do not exist in traditional stock exchanges. They have futures contracts that have expirations. You need to roll them over. This doesn't exist in this world, in these markets. And so once again, guys, we're here in the Empire State Building. We are bringing the convergence of these two industries together. This is going to be an accelerant for investors, stock brokerage. Once you kind of learn about this, you are really intrigued as to how it happens, funding rates, how it all happens. And so something to note. Well, for us, it's like we're used to it, right?
And I think for people to understand is that it's important to untangle the asset from the underlying infrastructure. Okay. And so we've learned this because when it comes to digital assets, you've got what people typically call crypto. They refer to two things, and ultimately that leads to a lot of confusion. What they refer to is the asset, think Bitcoin, and then think the Bitcoin blockchain. Asset and blockchain are two fundamentally different things. We're seeing this play out with the more legacy asset class, the high quality asset class as well. And so I think what we're going to continue to see is the invention of new modalities, the invention of new infrastructure. Perps is a technology. Perps is a piece of infrastructure. You can apply this to any asset class. You can apply Perps, you can apply blockchain rails, and that application of that infrastructure is going to improve the liquidity, the composability, and the speed and the latency of any asset class. And that's why this is ultimately inevitable. We believe it's inevitable. And this is going to be a transgression over time, where we're going to see more and more of the assets traded on these more liquid venues. Ultimately, it's going to positively impact the bottom line of whoever is trading these assets. You're going to be able to unlock liquidity. There is counterparty risk and liquidity risk when you're doing T+1, T+2 settlement. You have the cost of money. You have to insure some of these overnight things. You have custody risk, counterparty. So ultimately, we're removing risk by putting things onto more liquid venues and more secure exchanges. And then we're going to be opening up the abundance of capital in these markets. And so I think there's an evolution here. Yes, we're going to see high quality assets. We're going to see more high quality assets on chain. Those high quality assets are going to end up getting access to capital and lower settlement times, quicker, faster settlement times. What does this mean? I think is the next question.
Yeah, like what
is
this? So yeah, what does this mean for, because if we go to like tokenized treasuries, these are 1 billion, 2 billion, 3 billion coming on chain massively, right?
Repo markets are
Buildle
billions.
is huge. 𝗶𝗵 from Circle is big as well. Those are the big two. This is a whole nother, so that's Perps. That's on-chain price discovery. That's going to happen. How to position. We told you what our position is. We told you how we think about it. I don't look at I don't have really any other positions in any of the other perp dexes. This is a winner takes most market. I think there's going to be 3 winners. Right now, it looks like Hyperliquid, Lighter, and Variational or Aster. But again, I don't know. We'll see how that whole space plays out. But this next trend is like the big pie too. So like the perps pie is massive. I think it's something to definitely focus on. The tokenization and kind of like market infrastructure pie here is huge.
Right.
How would you describe what is the value of tokenizing assets? Like why is having tokenized gold or tokenized equities trading, why is that valuable?
It's a lot of the same value proposition that we've been talking about for years. And a lot of that is composability.
Okay.
And a lot of that is the innovation of lower settlement times, faster, and more affordable. And it's eliminating a lot of the risks that clog up the system, both in terms of time and cost. And so as you're thinking about, yes, high quality assets coming on chain, that does 2 things. One, it brings these assets into a place where they become composable with the entire asset universe that is already existing on chain. What that does is it allows these venues to become composable with one another. You can then take positions and use them as collateral and borrow against them and unlock liquidity against them, which is currently not possible in the existing legacy financial system. You can think, you have your Schwab, you have your bank account, you have maybe a fast cash like a Venmo or a Cash App. These are all disparate venues, right? A lot of these brokerages, these venues, they don't talk to each other. There's not a common language, right? On the blockchain, right, we operate on distributed ledgers, meaning that all of the validators, all of the nodes that are communicating across all of the blockchains, all of those speak a common language. On Ethereum, it's the ERC20 token standard. Other blockchains have other token standards, but ultimately, once things are on chain, they become a lot more composable with one another. They end up speaking a common language, and then they can start to communicate with one another, these systems themselves. And that means that we can start to unlock value that was currently not there before. That happens faster, and then we can apply that value into more assets. So you can think that once we have these assets on chain, you become you start to eliminate a lot of the risks that start to make costs in terms of speed and capital. And then you can also start to apply the unlocked value into more positions. I'm of the perspective of essentially you've got 2 asset classes. You already spoke about perps and all of the high quality assets like gold and oil that are coming on chain. Then you have non-speculative assets, and we're seeing the entire private credit market come on chain as well. And
show some cracks as well.
Exactly. And so I believe that now once this is moving on chain, the old adage when FTX collapsed was that if FTX was on chain, we would have seen the cracks a lot sooner.
Right.
And so we can see a lot deeper into the system itself who owns the risk, who owns the assets, and then ultimately we can make determinations based on that. So first off, we're unlocking a lot of liquidity once we have tokenization. The second is that we're improving a lot of the risk profiling that happens across the entire industry. And so on the risk profiling side, we're going to be saving a lot of time and money. And then on the composability side, we're going to be unlocking a lot of latent capital. Ultimately, these two things are improving the bottom line for companies like Blackrock and Fidelity. And companies,
we've seen it. I mean,
we've seen it. They're embracing stablecoins. They're embracing digital assets for a reason. It's because it makes perfect business sense. It improves their bottom lines twofold.
Yeah, I mean, so that's kind of tokenization as this pillar of the brand that we have, that we're going to be covering, that we think is part of this regime shift in a positive, optimistic way. And I think the kind of next and parallel is stablecoins, right? Is just this, we're sitting over 300 billion. I think USDS just cracked 11 billion. So just kind of broke through that 10 billion kind of level there. Tether is obviously in the first place here, circles up. And so this is a major area for businesses, right? Because they are going to be able to lower their credit card fees that they have to pay, those costs, any sort of failed card payments, agentic micro payments and agents using credit cards and stable coins on chain, and just the amount of money being transferred for global payments, remittances. This whole category is going to keep growing. And so stablecoins is very clearly part of the regime shift. And so I think if you think about perps, tokenized assets and tokenization and stablecoins, you have a winning portfolio to think about how to allocate to. And it's not easy right now. And there's some perps companies that you can allocate to. Tokenizing, there's a couple, but a lot of these are kind of more in the private sector. And then stablecoins, obviously you've got, the skies, the Athenas. As part of our N7, it's Sky. Obviously Circle has a stock, not financial advice. But those are like the big three of this regime shift that I think is important.
Okay, so I see your mental model. You got perps, you've got stable coins, and you got tokenization. I think those are three very, very key pillars. The way I'm seeing this regime shift is almost more of a progression. And so I think of it as, okay, stable coins are extremely important, and now we have regulation, and it's becoming even more accepting of stable coins. Once we have stable coins and high quality assets, right? Tokenization is the absolute foundation of a lot of this, because ultimately this infrastructure, it can support really anything and everything. The key is filling it up with high quality things through which we can start to transact, and we can use as value, and we can start to create more value as a result of it. And so once you have these assets on chain, and I mean both the speculative assets in terms of the high quality, oil, gold, things that are some of the most liquid venues, also equities, US equities, one of the most liquid traded asset classes in the world. Once you have these speculative high quality assets, and you have non-speculative cash instruments, treasuries, private credit, these sorts of things, you end up with a lot of value that is essentially sitting on blockchain rails. The thing about money is that it doesn't just sit, it moves. And so there's a velocity to this capital through which can become so much faster and so much more efficient on blockchain rails. And so my mental model is, okay, yes, first tokenize all of the assets, the speculative assets, the high quality assets, and the cash instruments. Once these things are on chain, then we have the plethora of DeFi, NeoFi mechanisms that we've been studying since we were DeFi Slate. And so what we have here is we have the mechanisms like the Aves, like the Skies, like a lot of the decentralized exchanges that we're now seeing get wide adoption from the most important, most reputable asset managers and financial institutions in the world. These are the building blocks, the DeFi Legos. If you think back to DeFi Summer 2020, these are the building blocks of a new financial system of a token standard. So yes, tokenize all the assets, make sure that all of these disparate venues can speak to one another and they speak the same token standard, and then start applying the DeFi building blocks that we know and love because we've been in this industry. But now you have high quality assets, extremely liquid assets with trillions of dollars of market cap in both speculative and cash instruments flowing through some of these mechanisms.
And so let's think of, and so let's get to this, right? So that is a really good point, because right now we're valuing a lot of these DeFi applications, especially the ones that we've been tracking in Neo Finance, and just a lot of these on-chain protocols and blockchains, just for the understanding that we're using crypto assets in them, and not that we're gonna bring billions and billions and billions of treasuries and private credit units and CLOs and on-chain and be able to put that in 𝗵𝗶𝗶𝗵 and loop that thing like, 100 times. Put it in 𝗵𝗶𝗶𝗵, use it across a set of applications like Pendle, Hyperliquid, Lighter, etc. All of these kind of like financial primitives on chain, they've been thought about and valued right now as kind of like what can be done with the crypto collateral, but not what will be done if all of the assets in the world essentially slowly but surely come into these applications. And so before we get there, this is, and on that topic, this is the cause, I believe, of this massive sentiment disparity right now, right? And so this is part of this regime shift, is that we have a massive sentiment disparity on, I call it like CT token bear market and institutional mania. And so what happened is that there's been this large amount of theoretical value created in crypto, right? The total market cap peaked around 4 trillion at the end of last cycle, right? We saw all these different tokens, all these blockchains, all this venture funding. We built a ton of infrastructure and a lot of kind of groundwork for the space, right? But we haven't really thought that deeply about actually capturing that value. And so there's this deep fear right now of institutions or whomever with large distribution channels, Robinhoods, Revoluts, etc., coming in, creating a POC for their on-chain endeavor and capturing the majority of the value because they own the user relationship, they own that application. So what we've seen is companies like Lighter have gone and integrated with Robinhood. Revolut is building on Polygon, for example. So you're seeing this kind of like DeFi mullet play out, where you've got the distribution partner and the DeFi protocol underneath. But there are many, 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 many tokens and protocols that are literally generating zero revenue, have got a ton of funding. They have maybe 12 to 24 months of runway left in the current market or less. And they have very little users. And they're the brutal reality is that it's kind of over for them. So I want to be optimistic here, but let me give you a reason to be optimistic. And we're not like, there's a lot of fat that is going to get trimmed as this regime shift happens, with clarity passing, so we're just going through this rapidly.
It certainly is, and I think this is a very important tangent into value accrual, which is that you mentioned that a lot of these protocols, essentially the teams and the companies that look, maybe they have research fetish, maybe they're doing things for valiant reasons according to their own complex. You said that they haven't thought deeply about value accrual.
Yeah. It's capturing the value that they've created. Like, we've built these blockchains, and we had this 𝗵𝗶𝗶𝗵 law idea where like there was these network effects that would drive a lot of these values to these L1s. It's yet to be seen if that's going to happen. I think clearly congestion fees and gas fees across all blockchains as a revenue source have decreased significantly. I'm not sure that the L1 trade is alive at all anymore. I don't think it is. And so that's kind of like one whole like network effect based thing. But yeah, how do you capture value in this space? And the problem is that there's these larger institutions or firms that are going to come in and capture a lot of the value that has been built by crypto natives, open source. And so there's this really nasty sentiment.
I don't think that's a problem. I think they're going to create a lot of value, and that's why they're going to capture a lot of it. What you have to do is you have to have a regulatory regime that allows you to capture value.
Yeah.
That's why they haven't been capturing value. It's not
Correct.
because they haven't been thinking deep. Some teams haven't been thinking deeply about it, right? But,
No, but a lot of these
they were
teams
going
do
to
not
zero
have any
anyway.
revenue.
A lot of the teams didn't
They're
have
not making-
product market fit, and that's why they didn't have
And I'm
revenue.
talking to
you have
VCs now.
you have other companies that felt like they had to sufficiently decentralize, and that was the
That's over. Dude, decentralization
It's
is
over because we have a regime shift.
Like
we have
at
regime
least
change.
until the coming
And
years,
so- and-
it's not over. But like the whole I'm very glad Ethereum is still pushing and Vitalik's still pushing for censorship resistance and all of these from the highest level. But like, dude, that whole DAOs are done. It is a hierarchical top-down decision-making on product and scale and speed. You're competing against fintechs. You're competing against 3,000-person firms.
Yeah. Yeah.
There's no more fugazi about DAOs and decentralization. That's over.
Absolutely. I'm not.
That's a
I'm
huge
not,
part of this
not
regime
fighting
shift.
you on that. But the part that I am thinking about and talking about is where equity meets token. And that is a part that has started to evolve very, very significantly over the coming months, or in the past few months, and continuing.
Yeah.
And that is that's a cornerstone of this regime shift.
Yeah.
And that's because that's why DAOs were created in the first place. Maybe there was Vitalik had some philosophical arguments as to why DAOs are important. We all believe in decentralization as maybe a decision-making mechanism, but as a corporate treasury strategy, no, it doesn't make any sense.
No.
And so DAOs existed so that you could put up some fugazi, facade in front of a protocol that actually did have some revenue that you could pass back to the token. But that's not happening anymore.
OKX just raised at a $25 billion valuation.
Yeah.
And the token is trading at $1.8 billion.
Yeah.
This is something that is going to change as well.
Yeah.
They will likely be merged to 1-to-1. And I don't know how that's going to look for backsetting that and going back and looking at all these protocols, figuring out how to actually allocate those. But this is coming together and it's going to happen because let's say Coinbase launches Base. You've got Base token, Coinbase stock. You've got this weird thing going on. It's just going to be one. And I genuinely think that there's protocols like Backpack are doing this. They're actually giving away equity to people in I believe in their airdrop or in their points program. So they're this is going to come together, and I think that's also a big part of the regime shift. So it's gonna weed out a lot of teams.
Let's drill into this Coinbase example because this is one that people like to use a lot. Let's say Coinbase launches the Base token. Let's also say that Coinbase tokenizes their stock, and now they have a tokenized coin stock.
Yeah, I know. Base is the L2, but you can buy coin on chain. You can buy Base on chain.
So then Coinbase has a token,
Yeah.
and they have a Base token. So they have two tokens.
It's weird.
So value accrual ends up, and you have different assets for different folks, right?
Yeah.
So you can have an on-chain audience buy the Base token. You can have an off-chain audience buy the coin token. But once these two things start to intermingle, ultimately you're gonna have to look into where the revenue is coming from, right? Where is it going? Yeah. And that is the question here that I would be looking into as a shareholder or as a token holder. And I would be looking for clarity on where my revenue sources are coming from, because ultimately the way that these things are valued, normally these token stocks, these P to E ratios, right? I'm looking at how much revenue you have and what are the chances that you can solidify those revenues and grow them over 5 years, 7 years, right?
Okay, so here's the thing.
Then you're trading 7 times earnings or 5 times earnings.
Well, so Hyperliquid came in with the Trump administration earlier. And I think it was about a year and a bit ago, and they said we're gonna buy all the revenues. We're gonna buy back the tokens with all the revenues. Trump's in office. We don't care. We're gonna do it. Yeah. That completely shifted the entire landscape of tokens, Trump and Hyperliquid. Yeah. And now there are tens of thousands of tokens with zero revenues. Yeah. And they have zero passback. And those tokens are done.
I'm not disputing.
They're done. I'm not and so that part of this. Part of this regime shift as an investor in this asset class is you have to have a consolidated portfolio. There is no room for distributed kind of spray and pray narrative-based tokens. I don't think that that's really going to come back in any major way. I think there are actual investable assets right now that are doing very, very strong revenues, doing buybacks, have open, programmable, transparent financial data, and are doing it at an institutional scale. And a lot of this industry is not going to make it past this phase. And there's a lot to be optimistic about because those winners that do win will accrue a lot of market value, and there will be a lot of upside for those over a longer period of time. But as you say, right now, these assets, they're just not like equities. They don't have a claim on cash flows. There's no direct ownership rights. And this will change with clarity. And so clarity is kind of this line in the sand, right? Let's talk about clarity because it's a big part of how this is going to shift. Big thing right now that's holding it up is stablecoin yield, right? But clarity is going to give us a framework to understand what digital assets can and can't do with regards to yield passback, with regards to all these different types of crypto asset frameworks. And I think it's going to be an obvious thing that marks the bear market, like a line in the sand of the bear market. It's be like,
are you calling bottom?
You didn't buy when Clarity Act passed at 46K, at 66K. You didn't. Clarity passed in 2026. That was obviously set the bottom for the 2027 to 2029 run. Duh. Right, but I think Clarity is this line in the sand that's going to be. This is going to mark the regime shift because it's going to be like, all right, guys, here's what's available and allowed and legal. Go build. And that is going to once again force the hand of teams that aren't prepared for it. So we've been living in this Fugazi bubble, and it's changing rapidly.
And again, the Rollup, we couldn't have done it without the guests who have come on the show. Two of my favorite guests that we've had on multiple times have been 𝗵cie, founder of Dragonfly, and 𝗶𝗵𝗶𝗵𝗵, founder at Inversion. One thing that I love about these guys is that they draw upon their experience in capital markets as a whole. 𝗵𝟐's got a background in poker, and he's takes more of a venture perspective on the market, and 𝗶𝗵𝗶 takes a very pragmatic investor point of view. And so if I'm looking at these things, I have to choose: am I 𝗵cie or am I 𝗶𝗵𝗶? If I'm 𝗶𝗵𝗶, I'm looking at things as a PE. I'm looking what is their revenue now. And what is the likelihood that they're going to be growing that revenue, and how long can they be protecting that revenue and or growing it over time? That is going to factor into some PE calculation. I'll come up with a valuation. If I'm 𝗵cie, I'm thinking, what is the chances that this thing ever gets revenue? And I think you can look at the crypto market, and you might hear us use the word crypto as a whole a little bit less these days, but when we talk about crypto, we refer to essentially the altcoin complex, right? Because we're untangling crypto and blockchain, and we're treating the crypto asset class as effectively the altcoin complex. We're treating Bitcoin, ETH, HYPE, revenue generating coins and tokens as high quality assets, right? And then we're going to see high quality assets from outside of crypto come on chain and join the Bitcoin and ETH and Hyperliquid. I have to ask myself, am I 𝗵cie or am I 𝗶𝗵𝗶, right? And if I'm looking at the altcoin complex, I can say, okay, yes, this thing doesn't have any revenue now. There's a chance, maybe a good chance, that it goes to zero. But then the 𝗵cie in me says, maybe this thing gets revenue one day. In which case I'm willing to take a flyer, right? Now, the fact that they've already launched a token and maybe it's in the market altcoin complex. That is probably premature. I think we're going to start to see a lot later token generation events. Because ultimately the way to do this thing is first you launch your product, then you get product market fit, you get some revenue, then you go public, if you will, which is effectively your TGP.
I agree, because I think that the pendulum is swung too far right now on the revenue meta side. Like, it's funny that I put that out like so long ago. I think it was like early last year. And we had everyone is now looking at the revenues of companies and like doing PDE and like trying to map out what the forecast is going to be. It's like, look, it's kind of gone too far a bit. I think we will get some of those network effects, Metcalfe's law, future revenue generation runs in different assets, and like the market will shift back towards like more optimistic thinking. But as soon as like any of this bear hits, it's just so bang, bang, bang on like, here's what it is now. Here's what we're looking at. And so I think that has shifted too far, and I think it'll come back.
That sounds reasonable. I want to answer the L1 trade kind of thesis here. I think the L1 trade as we know it is over. But I think there's going to be a new L1 trade brewing. It's this token. It's a combination of a tokenization trade and an L1 trade. It's the New York Stock Exchange, but first they're going to tokenize, but they're going to do it on their own chain, right? That's the new L1 trade. It's the New York Stock Exchange launching tokenized equities on the New York Stock Exchange L1, if you will.
Yeah.
How you get exposure to that is a different question.
Well, that's why I think there's this massive drag in sentiment, because there is no
people
way.
They're shut out.
There's no way to
they're
get
shut
exposure
out
to
of
that.
getting exposure to.
That's the biggest problem right now.
That's why we're here.
That's the biggest problem
Because
right
this
now.
is how
But I
the
agree.
Rollup
I
gets
think the
exposure
L1
to
trade
this.
will shift though. It'll shift towards the agentic finance trade.
That is
there's
what
going to
I
be
wanna-
like there's
that's
going to
where I
be
think-
like a
Yeah.
hopefully there's a strong demand for block space increase as agents become more and more able to interact on chain.
Yeah.
I think that could drive some real block space demand.
Yes.
But if I'm an agent, I'm just going to find the cheapest chain always. And
Well,
so
those things
there's
can
a lot
still
of
generate a lot of revenue
Yeah.
and take a more volume-based approach.
Well, then the whole kind of like the burn could come back for Ethereum.
Exactly,
Other
yeah.
L1s could get their
Yeah.
actual transaction count up. You can start to get more of that Metcalfe's law network distribution model. So I think the agents could save the L1 and L2 trades. But I have zero interest in participating really in a lot of those assets. The other thing here is that on the venture side, I think is really important to talk about when it comes to this regime shift is that a lot of these tokens are just meant to go down only because of their unlock structure.
Yeah.
And so I think that there's unfortunate reality for the venture of the space. There's only going to be like 5 to 7 VCs that are going to be able to raise big enough rounds in the future. I think to be able to actually do Series A or like actual large scale, like $15, $25 million checks. Paradigm, Dragonfly, Han, A16Z, Framework, and I mean, I don't know, maybe a couple others, some small ones that will get anywhere. I mean, Paradigm and Dragonfly just announced big rounds, at least Paradigm announced the desire to. A16Z did. So there's also a massive consolidation in the venture funding of the space.
Well, I'd imagine that a lot of LPs could be a little bit more enthralled with AI these days. And this is what I think we
they
should
also want more liquid strategies.
Sure.
Is what I've heard. So 2 things on the venture side that I think were interesting as far as the regime shift. Spoke to a guy at Drinks the other night, big prominent VC is deploying their fund 3 large scale. And he basically said that we're not doing any deals unless they have a clear path to revenue.
I mean, it
like-
sounds like a real business model.
Didn't exist
That's
a
what
year
we're
and
looking
ago,
for
a year
as
and a half
investors
ago,
these
or
days.
like 2 years ago. So that was a big kind of, it was like, if there's no clear path to revenue, if they're not already making revenue, we're just not even considering it. So I thought that was interesting. And then, I think there's a lot of drag. I think that's another reason for the sentiment shift is that there's this AI takeover of interest, of speculative interest at large.
Yeah. So agentic tokenized finance is the final frontier in this progression that I've been talking about.
Right.
Once we bring all the high quality assets on chain and we tokenize them, then we put them into our DeFi mechanisms that have now been resilient. We unlock a lot of the composability and the liquidity, and we get a much richer sense of the risk profile.
Yep.
Then the third piece of this, and AI is getting here, the third piece of this is vaults. Okay. Risk managers are extremely excited about vaults. Had Matt Hugin on from Bitwise, and he mentioned about why BlackRock is getting so deeply invested in the space. And the reason is because BlackRock missed out on the entire ETF business. And so he kind of wound back time a little bit and walked me through the mutual fund complex of the early 1990s and 2000s. What happened back then was essentially that you had socialized losses and it was a very inefficient structure. And so mutual funds kind of ran the world, but they weren't perfect. Then you had the invention of the ETFs. And it's pretty interesting to hear a lot of the commentary around digital assets and tokenization these days was very similar to the conversation around ETFs in like the mid 2000, 2005, that kind of era. And so BlackRock was essentially sitting back on their heels, almost like Apple is with this whole AI race.
Yep.
Apple's sitting on a lot of cash, might be apples to oranges, but BlackRock didn't get involved in ETFs right away. They kind of sat back on their haunches because they were major beneficiaries of the mutual fund landscape at the time. Then 2008 came around. Major bank, I forget which one it was, but they had to sell their ETF business. It was the previous owner of iShares. And BlackRock at the time, because they were sitting on all that cash, they were able to come in and purchase the entire iShares ETF business from this previous bank. And that ultimately put BlackRock in a position where, yes, they weren't the innovators or the creators of the ETF landscape, as it were, but they were able to come in and buy it, right? And so now Matt from Bitwise believes that BlackRock is getting so deep into crypto because they don't want to miss out on this next thing that they saw, just like they saw happen with the ETFs. They felt like they missed the boat on ETFs. They kind of got lucky, if you will, but they were able to buy the iShares ETF business. Now they have a more well-rounded business that way. But now they're putting their first step forward, and they're getting more involved deeply with crypto, tokenization, and digital assets.
Is the biggest, and that takes us into kind of like how these firms are going to get into vaults as well.
Exactly. And so now, once you have the high quality assets on chain and you have composable liquid venues for these, you have the DeFi building blocks, the Legos of the lend, borrow, and the decentralized exchanges. You have everything you need for the vault complex. And the vault complex is essentially an asset manager's dream because asset managers are able to come in, and normally they have to do really manual processes. They have to call someone if they need to liquidate something. They need to rebalance these positions manually. It's essentially their entire job, right? So now it's essentially like the AI version for asset managers. You put this thing into a vault. You can have a very, very broad swath of vaults that you can cater to your clients. You can have a risk on vault, a risk off vault. This one can generate yield. This one has this risk profile. This one has speculative assets. This one has high quality assets. All kinds of different vault complexes that you can create as an asset manager. The final piece of this,
I think this is a big part of the regime shift. It's like there's a bit of a kind of like a black box happening where these firms come on chain. They don't really want to get involved. They don't want to do it themselves. You got trusted curators, the Gauntlets, the Rockaways of the world. They provide very solid parameters and frameworks, and you're getting better yields than you are off chain. And so that's kind of like a really interesting thing is that that's part of this regime shift is that there are better yields on chain with some more risk. You got smart contract risk, you got DeFi protocol risk,
those risks
amongst
are
others.
coming down.
And the amount of exploits and things have came significantly down. But there are better yields on chain with these vaults.
Remember, once we have a better understanding of the risk profile, because we can actually see where the money is on chain, we bring a lot of those risks down, as making sure they're resilient, they're audited. As we have larger institutions come into the space and they deploy thousands of engineers at their fingertips on the code that is underpinning this. BlackRock has obviously done due diligence on Uniswap. That's why they're partnering Apollo with 𝗵𝗶𝗶𝗵. We're going to continue to see those risks, those smart contract risks come down, and we're going to see risk dispersion. We're going to have a better understanding of that. So we're going to minimize those risks. That's going to lead to less losses. It's going to also lead to faster settlement times and quicker latency. And then we're going to unlock a lot of the value, right? And these are ultimately positive things for the bottom line. The last piece of this puzzle, AI is the final frontier in this puzzle.
Just to close the loop on vaults, I think that this is something that is going to be very exciting. People are very bulled up about RWA looping. They really want to see this happen. It's going to keep happening. I've talked to multiple people about this. A lot of the private credit cracks, a lot of these institutional products, I think a lot of these firms think that they're going to come on chain and just like dump their products on the on-chain ecosystem, and the distribution that they get from this on-chain audience. Just something to note, guys. Like think about why these firms are wanting to come on chain to get more AUM, to get more fees, to sell you more products. Like, it's a really nice time to be at the forefront of this convergence. But when you think about the incentives a bit more, you understand why the sentiment gap exists, such that we built all this open source technology, and then there's a bit of a vampire attack happening from the outside.
Look, I think, there might be people that are disillusioned with what they thought crypto was and is, and where it's going. I'll just say, like, I've been in this space for, we've been in this space almost 10 years.
Yeah.
Right. Each. Right. And the best way to get exposure is to build something. I would encourage people to become entrepreneurs, especially in the era of AI.
Yep.
It's not that you can just buy an asset that got TGE'd and ride it to the top anymore.
Yeah.
You may realize where this space is going. You may realize where the industry is headed.
Yeah.
But you may feel like there's no way for you to partake in the upside of it because there's not some instrument for you to buy. But there is. Create your own instrument. Create a company.
Yeah.
Go where the convergence is happening.
Yeah.
Seek out, a lot of the value that you think is coming, and provide, your own contributions to it. And I think you can capture a lot of upside that way as well.
Dude, before we get into AI, let's talk about the regime shift about culture and conferences. Think like culture-wise, right? So there's a bit of a clash happening right now. Vitalik even put in one of his recent posts to like take your suit off, go, leave your like high status slop membership club or something, and like go and be free, right? And at the same time, you've also got the rapid professionalization of the space. We're in the Empire State Building.
We are quite.
This is the beginning of our attire. You're gonna see NFT PFPs go for the space at large. You're gonna see the conference strategy change. You're gonna see the culture change. Like I don't know. There's just these butting of heads of like keeping crypto fun, weird, and cypherpunk versus like the industry is growing up like from an age perspective, right? Like our first conference, we were probably like 18 or 19. There was people in the industry from that age all the way to like 30.
Yeah.
Now those people are, anywhere from like 26, 27 to 45.
Yeah.
And so the industry itself is growing up. So I don't know, I'm just curious, anything on like the culture side, like how do you expect this regime change to impact culture, conferences, and how this space is going to grow there?
Look, it's pretty obvious where we sit on this topic. We are quite literally in an ivory tower.
Okay.
I mean, like the walls are painted ivory, and we're on the 77th floor of the tokenization tower. So, we are embracing this, right? With open arms, but it doesn't mean we're abandoning our values, right?
Correct. That's the important part.
Yeah. So, we are transforming along with our industry. I think also part of it is becoming malleable and adaptable.
Yeah.
But never sacrificing on the things that you hold, very, very important to you.
Yeah.
Personally, I'm a believer in this technology. I'm also a strong believer in technology. And I think the blockchain is a very important technology. I think it's extremely innovative. People are going to use technologies for very different things. Some people are going to use blockchains for decentralized social media and NFTs. Other people are going to use it for, getting 3 more basis points to their bottom line because they can reduce the risk profile of their assets. Okay, I think both of those are extremely positive use cases.
Yeah, so use the technology, understand it, appreciate it. There's going to be subcultures, subgroups always, like with anything.
Yeah.
When it comes to
I'll just add a little bit more color there because, the subgroups typically have found their own venues to inhabit. And so like but on the blockchain, that's not necessarily the case. This thing is decentralized by nature. You can have 2 disparate worlds that are composable with one another.
Well, right. Inclusion works both ways, right? Like if you include everyone into a space, into a financial stack, you can also kind of like choose, you include all, and then you can choose what you want to be, right? Like you can be whatever you want to be in the space. And so I think what
That's right, yeah.
Like what I'm trying to say is that yes, you can be accepting to all, but there's going to be these subcultures that form like within. Look, I think it's about your strategy, right? If you're a protocol, a product, a business, who's your audience? Who do you need to sell to? Who are you trying to build a recurring, revenue source with? Who's your customer? Where are they? Are they at ETH Denver? Are they Spork Whales? Are they developers? Are they at Money 2020?
Right.
Are they at in Vegas at a fintech conference? Are they at Simon Taylor's NerdCon? Are they at Consensus Miami? Is it at like a Cybos? Like who's your customer? Who are you trying to play with and like kind of target and then adjust your strategy to that? But I think at large, like there is a growing up. Like you will not be taken seriously, I don't believe, unless you have a very refined brand that shows legitimacy and credibility, shows a understanding of the professionalization and kind of growth of the space, and is not like this narrative driven hype thing. Like we're so beyond past that. So look, I think like my thing is like the culture is shifting. People are growing up. The space is growing up. We're all growing up and maturing. And look, we're trying to do our part. I think everyone's going to do that, because at the end of the day, like we haven't been taken seriously by the world. Like just finally, like we're getting a lot of this adoption happen. I think like a big part of this regime shift is that there's going to be a trimming of a lot of the hocus pocus and a lot of the kumbaya, and a rising of the professional. Like this, that's just like how I think about it.
So I agree with all of that, and I think part of the reason why that's happening is because AI is taking a lot on the peripheries.
Yeah. So let's talk about that. It's reshaping company operations.
So just this kind of the transition here of AI here is like on the culture and conference side of things. You have AI is so amorphous, it's so weird, and it can be used for so many different things that at the extremes, it looks a lot weirder than crypto. Crypto back in 2016 to 2020 was it was a lot more new than AI. AI has been around for 40, 50 years. You got a reinforcement learning and different machine learning tactics been used for a long time. But AI in the modern context is actually newer than crypto. And so crypto, and I mean digital assets, blockchain, not necessarily the altcoin complex that we think is dying, but crypto as a whole, the culture of it has solidified. It's grown up, and it's I think what happens as it grows up is that it solidifies and it kind of like reaches this final form where it's like, okay, when something's, and think about like a kid, right? When it's in kindergarten, people ask, what do you want to be for, you can be an astronaut, race car driver, whatever. It's so broad, it's such a broad spectrum of things that you kind of have the ability to do any one of those. Crypto was in that position, right? When it was extremely new. It could have been anything, right? But now as it's matured and gotten older, it's kind of gotten pigeonholed a little bit. Not in a bad way, but it's solidified into what it is actually, all right? And I think that is going to continue to happen. It's going to continue to ossify into the thing where it really has found its product market fit as an industry.
Yeah, and I mean it's reductive to say it's just finance, but clearly any sort of like all of the revolutionization of finance is going to be where the value is mostly going to happen right now. Like it's kind of like this annoying step that we're in where it's like everyone's got to grow up. We need to ship products that work. We need to onboard institutional flows, tokenized assets, stablecoins, T-bills. We got to do all of this stuff. And then we'll get to a point where we have this like burgeoning on-chain economy. Yeah. But we're in this like annoying middle ground right now where prices aren't moving.
Yeah, it's called a bear market where we actually have to do the work.
Adoption is flying, but prices aren't moving, and they're like it's like the weirdest, most like weird bear market.
I'll just comment on the it's only finance thing. It's only insofar as the best example of this is prediction markets. It's only it's insofar finance insofar as prediction markets are finance, but they're also like really. Like they're tools and tactical things that you can use for things outside of finance when it comes to probabilities and understanding the future outcomes of things. And so I think, yes, right now it's only finance. Maybe we get somewhere else. But, just to close my previous point was that, crypto was new. When it was new, it was weird. It could have been anything. Now it's solidified, it's matured, and it's essentially grown into what it is going to be. AI now is extremely new. It can be anything. You can use it for anything. It's getting very weird at the boundaries. And I think new people, like younger people, are going into AI and they're using it for very weird things because they can use it for you can't really use crypto for anything very weird right now. And that's getting reflected in the culture. I think this ebbs and flows. AI is going to grow into itself. It's going to get sort of like less interesting. Crypto can, then grow and expand and blossom into a new fold. I think something that, go ahead.
No, I was going to say, I mean, JP Morgan had massive layoffs. Amazon Prime Video had massive layoffs. Jack Dorsey's company, Square, massive layoffs, or Block. So it's happening too. And
both of these, both of these things are happening. And this is what I wanted to talk about, the final frontier here for this progression of the industry as I see it over the coming 5 years. Put the high quality assets on chain, put those high quality assets into DeFi mechanisms, put those structured products into vaults and allow asset managers to manage them, and then make the asset managers AI. And once you have AI agents managing vaults made up of complex looping strategies, yield strategies, risk curated strategies, structured products of high quality assets, you end up with the new financial system. So that is what I'm extremely excited about. I think it takes place on a 5-year time horizon, but ultimately I think
5 years. I think it's more like 5 to 15.
5 to 15 years. Well, look, I think a lot of assets are getting tokenized.
But I think
you're seeing price discovery happen in real time on Hyperliquid. A lot of these RWAs are starting to become composable with the rest of DeFi. And you have 𝗵𝗶𝗶𝗵𝗶𝗶 that people are using for very weird things. So yes, AI agents managing vaults made up of high quality structured products, I think, are a very weird use case for AI agents right now. But I think 5 years is a long time, man.
I agree.
I think the world can change a lot in 5 years.
Agentic finance is certainly a part of this regime shift. It's the usage of AI internally for your company's work, whatever that looks like. The usage of actually using agents on chain, that's finally accelerating. Like we're finally getting agents on chain, right? Like it's coming. And the intersection of building smart contracts with agents and AI, this is all kind of like a corollary to like these big categories that we define. So if I was to kind of like put a summary on the regime shift and kind of close this out here, Perps, tokenization, stablecoins, major things to be very optimistic about in the current state of affairs. There's zero reason to be bearish on these. These trends are going to rapidly accelerate. If you've been following our Neo Finance kind of outlook, we've covered a lot of these assets. And we've also just covered kind of this at whole. That's happening. So that is really exciting. Vaults, also a really nice touch to kind of like add on to that.
I would structure a lot of those same advancements of our industry on a timeline, because ultimately I think there are things that are prerequisites to the things that will come after that. And I think you can't have AI agents until you have vaults. And I think you can't have vaults until you have DeFi mechanisms with high quality assets. And you can't have high quality assets on chain unless those are tokenized.
And so that brings us to a really good point, which is so that those three kind of buckets there plus vaults, it's genius.
Perps, tokenization,
and stablecoins
and vaults.
It's that. And then it's Clarity Act passing. It's genius being implemented. That's kind of like a progression that's going to happen as well on that timeline. And this is already starting to happen, but that is causing the mass wipeout of a lot of fat in the industry. We're bearish on a lot of tokens, on a lot of teams with no revenue. I'm just not excited about it. There's no investable case in it, which that is leading to a consolidation in venture funding, the ability for VCs to raise. We're going to see a lot of consolidation there. We're not going to see a lot of these VCs shut down office, but we're going to see them turn into more like liquid kind of like broader macro cycle traders.
Look, investors. I think this is happening, right?
So the revenue meta is going to keep happening. We're going to see that, but this pendulum has shifted, right? The pendulum has shifted a bit too far to like, let me go on DeFi Llama and analyze exactly your revenue forecast. Look at your P/E. We'll see some of that Metcalfe's law optimistic network effect trade return. And that's probably going to be driven by the agentic side of things.
I really do think, perps are an important part of this. Clarity is an important part of this. These are accelerants. And I think ultimately, yeah, we're progressing along this timeline. It's up to everyone who works in this industry and the regulators, everyone who contributes to this, as far as how fast we accelerate down this timeline.
Yeah, and so what this looks like from a portfolio perspective is less asset ownership. It looks like trying to own really quality assets in those three sectors, and potentially in that vault.
You're structuring this as three sectors. I see this more as a progression.
Okay.
Right?
Okay.
But ultimately, what I think this is you have your perspective, I have my perspective. We're talking about the same thing.
100%.
It's Neo Finance.
100%.
It's Neo Finance.
It's the convergence where digital assets is meeting finance, and it's happening. And so just kind of keep rounding out and summarize this point.
It's the evolution of finance itself.
Correct.
Right? As high quality assets evolve into programmable money.
Yes.
Right? As we have programmable collateral in DeFi and in mechanisms like vaults, we end up with high quality assets that are the next iteration of the things that they were. It's before, it's when gold was, something just plucked up, in the Hudson River. You got to go to California for that. But, you would take it and then it was an ETF and then it was a tokenized product and then it's a tokenized product that earns some yield in a vault and then an AI agent manages that tokenized product. And so what we're talking about is really
it's an evolution. But that's what the regime shift is. It's not a single point in time. It's this ongoing thing that has been happening, you could say, since 1010 or since Hyperliquid launched or since the administration came in, but it's been happening. It's gonna that is what's happening, and we're just kind of in the middle of it, helping people navigate through it. And it's a big change, and there's a lot of more brutal realities to it, but there's a lot of things to be optimistic about. I think, again, on the culture side, on the business side, it's the era of the mature, sophisticated kind of professional brand. It's not this hype, fugazi, decentralization, DAO structure. It's structured, hierarchical decision-making, fast execution, product-oriented, user-oriented results. It's focusing on conferences and branding and conversations that actually matter to who your customer is. And unfortunately, in every bear market, it means being somewhat firm with, what your bottom line is, what's going on, who you're supporting. But through all of this kind of somewhat pessimistic side of this regime shift, there's so much to be excited about, because we will get into a time where we'll see a lot of value be consolidated into really quality assets on chain. We already see a couple, and this will provide multi-year to decade-long investment opportunities with tokens that look more like equity, with claim on cash flows, with real rights. This will provide you to own wealth and store wealth, not just in Bitcoin, but in other assets. It will provide a magnificent onboarding of a lot of assets on chain, a full tokenized revolution of the way assets are traded and managed and settled. It'll bring a rise of capital formation that will drive such value and such democratized access to opportunities that we've never seen before. There's a lot to be optimistic about. We got to get through this regime shift. You got to know how to position for it as an investor. You have to be willing to be adaptable and to recognize what's happening in the space. We're going to try to help you guys do that day in and day out here from the Empire State Building live on Rollup TV.
We're going to continue to learn as much as possible. We're going to be speaking to extremely knowledgeable people in the industry that are going to be coming into the Empire State Building. They're going to be here in the nest, and we're going to be sharing all of these conversations with you as a very, very important part of the Rollup. Couldn't have done it without you guys.
Guys, hope you enjoyed the first show from the Empire State Building. The regime shift. It's on. We're here. Thanks for watching.
See you next time. Thanks, guys.